Hello everyone, my name is Jesse Dillon and today I'm pitching German American Bancorp. It's traded on the NASDAQ, the ticker is GABC, and the market cap is 386.1 million. Fair value I calculated was $28.17. It's currently trading at $29.39, so it's a downside of 4.15%. Average volume is 24,487 shares. My recommendation is to sell the position in the portfolio. So given that this is a financial firm, I ran a dividend discount model to see how the company will perform for future growth anticipations and macroeconomic factors. And a little bit about the company is they're a very strong Southern Indiana financial services provider. They specialize in banking, insurance, and investments for business and retail customers. So with that being said, I did research in the area and I learned that this bank is highly concentrated in southern Indiana where population growth is fairly consistent. Therefore, the bank will not see a large upswing in interest-bearing revenue. So my current valuation indicates the company is overvalued. A couple things I looked at when running my evaluation was just the operational revenue and how the ratios are compared to their peer median and peer averages. A couple ones I really focused on were net interest margin and efficiency ratios. These ratios as follows are accrued measure of profit margin between costs of raising funds and the earnings on those funds. So high is good and efficiency ratio is lower value indicates that they're running at a greater efficiency, so which is good. And just as far as how they perform compared to the industry average and where they're going to be at and what their plan is. Another thing I really highlighted on was the loan portfolio. I focused on how risky these loans are because in 2015 they're going to have to be in compliance with the capital adequacy ratios. So in order for them to be adequately capitalized, they need to have a risk-weighted average in certain sectors in order for them to be sound as a bank. And I noticed that they're issuing riskier loans, they're increasing their provision for loan losses, which kind of raised a red flag to me. I mean, they're really trying to generate more revenue, but going through riskier assets is not the way to do it because they hold a lot of risk and they have the risk of not generating the revenue that's promised. And also just looking at analyst recommendations was a big thing. See if they perform with the market and what the target price was based on other analysts who are watching the stock. And we pretty much got what we needed out of this stock, and it has performed for us, and I think that it's a good time to get out while we're ahead, and that's what I'm thinking right now as far as we're currently trading at $29 and my downside's a 4.5% downside, and it could be a lot worse, so I think it's a good time to get out of this stock.